Here we go. All right. Hey, welcome everyone to February. Boy, we're already through January. January was a quick January. Welcome to February the 3rd. It's a Wednesday. We're going to move this over to Wednesday. It seems like more of you are able to attend on a Wednesday, so we will be doing that. The Hurley Investments commentary, the midweek commentary. Last week, and I understand it's not up on my website. I had a little problem, but I'm going to get last week's and this week's notes posted on my website. But I had well, let me go through this. I had an article called "Investors Keep Your Itchy Finger Off the Trigger" by Eric Rosenbaum, and today I put an example of the Dow Jones Industrial Average up there. And I believe I am recording. Thank you, Abraham, for reminding me, because the day you forget to remind me, Abraham, will be the day that I don't do it. Alrighty, so let me go through this day today. I'm going to grab a pen color here. Ridiculous. In fact, futures were up through the night. They were down through the day. And boom, we came right down till 10:30. Anyone know what happened at 10:30 today? What happened at, actually, you know what? Let's start this off a little bit differently. What started our downward movement? What started our downward movement? Happened in the futures about an hour before the market opened. What happened about an hour before the market opened with our futures? Anyone? And if you don't know, go ahead and type a couple question marks in there, so I won't waste any time waiting. If you don't know, just go ahead and type a couple question marks in, and I won't waste our time waiting for someone. All right. What came out was the ADP employment numbers. We were expecting 190, came out at 205. This is how ridiculous our stock market is. And I'm going to say this with all due respect. 205 versus an estimated 190. So, good news is bad news. What happened at 10:30? What happened at 10:30? And again, if you're not there right off the figure, there you go, coffee time. If it doesn't come to you right out of the gates, go ahead and put a question mark in. 10:30 ISM numbers came in. Expecting 55.0, came in at 53.5. So our services index is worse than expected. So guess what? Bad news is good news, because no sooner did it come out and we ran up. What do you want to call this time in here? Till right about here. What do you want to call that time right there? You guys can make up a name. I want to be honest with you. You can make up a name. What do you want to call that time right in there? Definite indecision. I'm just going to call it stupid. Everyone's too stupid to know what to do. Head scratching. I like the head scratching, Rick. We're just call it stupid. And then all of a sudden, around 2:15, we run up, have a bit off a sell-off, but end up in the middle, and our market closes. Shocking. Absolute shocking. So, with all of that said, let me tell you how some of my day went. Phone call with 2 potential new clients. And one let me know that year to date, that from November of last year to today, he is down over 25%, but he thinks he has it figured out. So, with this comment, what do you think I should say? What do you think I should say? And again, if you don't know, go ahead and type a question mark, because it's really, there's no right answer. But from someone that's me, that spent all these years studying, managing tens of millions of dollars, Keith just asked, what was the strategy that allowed him to have that kind of loss? Keith, I want to be honest with you. I never got that far. And the reason why is because what I wanted to say was lazy. It was about a 15-word sentence, and every single word was a 4-letter word. What actually came out of my mouth was something along the lines of, right. I was shocked. I was really shocked. Second comment, and actually let's differentiate these two. Let's do phone call number 1. And let's do a phone call number 2. The potential new client with Wells Fargo, not sure, doesn't like his returns and worried about another 2008, which is perfectly understandable. His comment was, I think I should look into what you are doing and who you are. What do you think I should say there? Don't bother, just send me your money. Well, it's kind of funny because my answer was right. um, I was frustrated today with phone call number 1 because it has taken years of learning, education, money spent to learn, money lost in the market, frustration with me from a spouse, living in my parents' basement with 3 kids, up at 5:30 a.m. every morning, and most never like, I'm going to say this, most I can never please, no matter how well I do. A lot of people tell me, man, I want to do what you're doing. And part of me just wants to go, right. You want to go and spend money on 3 different educations to the tune of $35,000. You want to trade for 7.5 years, taking 50 grand to 280, taking 15 up to 80, and have nothing to show for it after 7.5 years, or roughly 15,000 hours. It's not 5,700 hours, excuse me, 5,700 hours. You want to go ahead and to save money, you want to go ahead and move out of your house, sell your house, and go live in your parents' basement for about 2.5 years to get a business up and running. You want to have your wife frustrated with you. You want to get up at 5:30 to read endless news and see the future so you can answer clients' questions, whether it has any bearing on what you're doing or not, because you're collar trading. And no matter if you beat the market by 10% or 100%, you've always got a couple that never seem to be satisfied. It's interesting because when I hear people that tell me, you know what, Kevin, I want to do what you're doing. Part of me again just says, right. Guys, you are a small minority that has found a system that works, that wasn't promised, hey, if you do this, you're going to turn $10,000 into $1 million. You're a small minority that's taken the first steps to learn a proven system that protects money on the way down. It makes money on the way back up. A proven system that can adjust losses into less of a loss, sometimes a break even, and sometimes a profit. A system that's going to give you some hope that you can have a better way than an asset allocation model. A better way than blindly following someone whose results never equal what they told you in the past. A better way that if you have another 2008, you can be up anywhere between 8 to 18% by doing nothing more than adding one extra long put as stocks are falling through support levels to create a negative delta. You guys are going to put in some hard work. You're going to need to paper trade every single strategy. We tell you should paper trade every strategy about 5 times. What we really want to say is you should trade it about 50 times. So you know what you're going to do when it goes up, down, or sideways. So that if you have a day like today, that you can work through it. That if you have a 6-month period like December where it's still bearish, that you can make some good money down here, make some good money on a move here, make an adjustment here, make some great money back up to here, miss all of this because it's ridiculous, but catch some part of the wave here. And looking right now, we've got some higher highs and some higher lows. You know where most people are at this position? They're down somewhere between 8 and 15% in their portfolio. There are a couple that are just outright lucky and are profitable. There are a couple like me that are down 2 to 3%. But man, we've got money to pick up, and we have picked up shares of Baidu, shares of Apple, shares of Visa and Disney, a lot of shares of Ford. You guys are the ones that get through this, maybe not with a smile on your face, but not without losing ridiculous amounts of money. One more time, if your portfolio average is 0% return and you lose 50, actually let's do it this way, you make 50, you lose 50, how much would $1 be worth? How much would one simple dollar be worth if it averaged a 0% return? Made 50%, lost 50%. Or lost 50%, made 50%. How much is that dollar worth? What, you're telling me a 0% return on an asset allocation model nets you a 25% loss? Your dollar's not a dollar. Your dollar went from $1 to $1.50 down to 75 cents. Or if it's the other way, your dollar lost 50 cents and it gained 100% return, or 50% return, lost 50%, and gained 50%. You're only at 75 cents? Thank you, Keith. Keith said, right. Asset allocation models don't work. An asset allocation model is a waste of your time and is a waste of your money. An asset allocation model is the reason why Ford stopped a pension plan 20 some odd years ago. Yet they're still paying into that pension plan 24 24, 25 years later. Because a 7.75% average return does not mean the portfolio grows. Because any big box, Fidelity, Morgan Stanley, JP Morgan, Chase, any of the big boxes out there, plain and simple, any big box out there is charging way too much to be in some asset allocation model. An ETF that has, a 0.25 managing ratio. I would love to spend some time with you guys and help you understand what it means to find out how much you are really paying for a fund. Boy, I don't know if they're here today or not, but I do want to make this point. I am really grateful I got to speak to two people today. Because I'll be honest with you, I was pissed after the first one. And I'm grateful that I got to have a second conversation. There are two simple lines right there. Bottom one, support, starts at March 3rd. November 4th, 1996. 765. To March 2nd, 2009. 765. Working those rough numbers in my head, 96 to March, I think I come up right there for 13 years. March 2nd, 2000, 1563. November 2nd, 2007, 1563. July 2nd, 2013, 1563. I hope I'm making an impression on you that we have had our lost decade. I hope as you take a quick look at this and see if we take a quick look and we get the correction we expect, what happens if in 2016 I now tell you 1563 and we do a 16-year flat market from March 2002, from March 2nd, 2000. And the funny thing is, you could have put money in here, but flat is flat is flat. And you'll notice, even putting money in here, you're not exactly growing. Kevin, why is that? Why would it not exactly be growing? That doesn't make sense. kind of simple. You know what? I should probably put that in here, huh? What a great, I love what you can do with some of these. What an amazing screenshot. If you don't mind, I'm going to do the same thing down here at the bottom. I hope this is powerful. I hope I'm not just wasting your time here. Why do people not make money in an asset? Story of $1. Let's put that in a little different context. Or lose and gain. 50% is not a 0% return. More importantly, management fees, which really equals commission to a licensed person like me. You have an account senior manager. You have an account junior manager. You've got a broker. You've got ticket charges. You have 1201B fees, which equal right now 1%. You have restructuring, rebalancing, turnover fees, which all equal, in my opinion, churning fees. I'm on one today. And I'm glad I've got the 7 of you here, because you are one of the few that doesn't have to go through this. If your wife doesn't want you managing your IRA, your Roth, your old 401ks, you need to roll over into an IRA, I can do it for you. If she doesn't want you to do it, take it and do it. But you guys are the few that are going to get to make a difference. And you guys are going to be the few that are going to get to retire. They're going to feel comfortable having money set aside. You guys are going to be the few that are going to get to make a difference. And it's not even hope, Alan. It's just a matter of time. In all honesty, it's just a matter of time is all it is. All right, I need to get off my soapbox here. Let's get to work. What's happening this week and why? What's happening this week and why? Start spitting stuff at me. What's happening this week and why? Instead of going 2 days, we got 3 days of information. Wow. Deanne, nailed it. I can't say anything to that. Volatile. China. Oil. I'm going to say oil equals Saudi Arabia and Russia. No compromise for cuts in production. And then we have earnings, right? I like it. So with all of that, where does our market end this week? Yeah, you know what, Dan? Really hard to say. One thing that's interesting, the new normal means that no one knows what's going on. Welcome to your new normal. You know what we do know, though? We do know that we've got a bit of a bullish uptrend on the Dow. Still technically bearish. Wow, why don't we just copy it? We know for the S&P. Oh, you better believe it helps you. S&P. Same thing. Problem with both of these, that dang median line is acting as resistance right now. And you know what? NASDAQ's exactly the same way. Glad to have you, Maud. Maud, we're recording it. You definitely want to hear the first part. One more thing I can tell you. You know what? Doesn't make sense. So we've already gone over that, so I'm going to go ahead and keep it like that. Where do we think February is going to end? I'm going to send it to you guys. Let me get a poll question out to you. You guys should see a poll question to give you a heads up. Right now, the S&P 500 closed at 1912.53. 1912.53. I've got a lot of bands there. You guys should see a poll. If you don't mind, on your screen, you should be able to vote for where is it going to end up. And to let you know, it basically started around 1940. Okay, I'm going to shut that down. I'm going to let you guys see what you voted. I'm going to say historically, February is a pretty dead year. It's down like 0.6, it's up 0.4. A dead year, a dead month, excuse me. So I'm going to go with up 1%. And there's a reason why. So I'm with that one or two people that said 1960. That's where I would be at, the people that said 1960. My general idea behind it comes back down to nothing more, and if I might go up to that S&P, let's do it this way. What I think, and again, what I think doesn't matter in all honesty, which you guys love to hear, I know. What I think, and by the way, what I think doesn't matter, come on. What I think is, I think we're looking at a lot of 2015. Big drop down, really choppy. And then in February, we started to come back up. We had a bigger drop down. We're kind of doing our kind of choppy. I just think this is extended out. I really think we're going to go through, in all honesty, this year we're going to go through that. We're testing the lows of 2015 right now. I don't know if we're in a secular bull run. I don't know if we're in a bear market. What I do know is growth is awfully dang slow. And because I know that, I don't give a whole lot of weight to where our markets can end up. Earnings, I've got a bunch of earnings. I'm going to put those in, but the short answer is not much is happening economically, internationally, and everything the end of this week is going to come down to, it's going to come down to Friday. Today we had the ADP employment, and we had the ISM services. Tomorrow we have initial continuing claims. Boy, it's a big end of the week. Challenger job cuts. We've got productivity. We got unit labor costs. We got factory orders. And these are the preliminary productivity unit labor costs. And then on Friday, non-farm payrolls, private payrolls, unemployment rate, hourly earnings, consumer credit, and trade balance. What a ridiculous weekend of the week, which means more volatility. I made the comment, I'm kind of following along with this. I will cut some pictures out, but protect for purchase and callers to get me 3 earnings. Then I roll puts out as I need to keep I roll puts out, says I need to. So I can keep them out of the expiration month. I need myself to get some more time. Earnings coming up for Disney, Baidu. Pretty interesting. Disney will roll from 100 to March 95, and Baidu did roll from 175 to March 155. So I'm taking my long puts, I'm getting them out in time. Capturing profits before earnings so they can bounce back up. I should just probably put it like that. Guys, I do a lot of time reading articles. I spend a lot of my mornings reading articles. I then do the best I can to literally see if I can't, I don't know how to say it, see if I can't verify their numbers. I've got a lot on Apple because I've had a lot of questions on Apple. I've got a little bit about Baidu. I've got some more down here on Ford. I'd make a suggestion that if you want to see what I'm reading, a lot of my most important stuff I put in here for you guys. This is stuff where I've worked the numbers and I feel what they're telling you is honest and correct. There's some of these I work the numbers and I think, what the heck are these guys thinking? Because I don't get it. I want to leave it up to you guys. 15 minutes up to you. What would you guys like to talk about or go over right now? Am I moving out of Apple into Facebook? Dan, yes. I've got about 2,000 shares of Facebook. Apple's taken such a crush, though. I'd like to see Apple. I'm going to start moving more out of, I guess here's a short answer. I've just bought Facebook is more of my answer. I'm looking at getting, I haven't put new money in it because it's speculative, but I'm looking for a pullback. We're kind of getting it today. New money will go into Facebook at 110. If I have to sell Apple, I'm waiting for Apple back up to that 115 level until I sell a third of Apple off, and a third of Apple for me is about $1.4 million. It's about $4 million in the in a business one, institutional money, I guess, best way to put it. All righty. So I think Facebook has more opportunity than Apple does. Apple's getting crushed by the law of big numbers. What's the law of big numbers for Apple? Has to hit its iPhones, has to hit its iPads, have to hit its Mac numbers, has to hit number of watches that are sold, has to hit earnings on the EPS, earnings for revenue, future guidance, has to make it on Apple TV, has to make it on the services growth now and how much people buy their apps. It just has law of big numbers. It has 10 different numbers. It has to knock them all out of the park to move higher. Should I get out of the Russell? Steve, the Russell historically, the first quarter makes its big run for the year, so to speak. Obviously, this year it ran right off a cliff. The Russell literally used to be, hey, if you want to play in the rut, you go ahead and play in the rut because the first 3 months of the year, you can make what the Russell makes for the whole year. And it usually has that run up. And I'm going to highlight some of the runs up. Runs up. Runs up. Obviously in 2000 it had a run down, but run up, run up, huge run up, flat that year, so you can't really use it. Run up, down that year, can't use it. Usually it has that run up. Usually, again, a small run up right there. But usually, beginning of the year, you have those runs up. The run up is really that first green bar are usually the runs up that you see. So, obviously, when you look at this year, no run up, run down. um, I'm not a rut trader, but here's what I'm going to tell you. The trade on the rut is broken right now. In fact, I'm going to go as far as to say, guys, our markets are broken right now. Our markets can't find a bottom. Our markets don't have a direction, don't have a catalyst. Catalyst isn't through earnings. Catalyst I would have thought was oil. It's not through oil. We've gone too far without a pullback. And because we've gone too far without a pullback or a correction, we've gone too far without a correction. Because we haven't had that correction, the market doesn't know when to sell, when to buy, how much to sell, how much to buy, when to stop selling or when to stop buying, when to start buying, when to start selling. We're lost. We're completely lost with no direction. I would not be in the rut right now. But you've paid so much, or you've taken so much pain in being in the Russell. At the same time, it'd be awfully hard for me to sell at the bottom. I always get this comment. I've heard it. It's not coined by him, but I've got a friend, William Gould, worked out at Goldman Sachs for a while and so forth. Comment: stock market's the only place where, when it goes on sale, everyone runs for the exit. So, that's a tough one. I think you've got better opportunities elsewhere, but it doesn't make sense to go through all the pain and not make any of the rebound back to the upside. Dan, so if I have new money, should I go towards Facebook rather than Apple? Dan, if I had new money, I am putting it towards Facebook, not Apple. If you chose to do so, that is your choice. I am licensed, bonded, insured, but I'm pretty sure at this time you're not paying me yet for a suggestion. But what I can tell you is I personally am putting new money into Facebook versus Apple because the law of big numbers have caught up to Apple. It just can't catch on there. And a 10-for-1 split. Yeah, Monty, yeah, Apple's got some issues. Music is because Apple again. Do you think that it's the fault of the Fed manipulating markets? No, I think the Fed, in all honesty, Maud, I think the Fed has stepped out of the markets, and I think the Fed has manipulated the markets for so long that the markets are having a hard time finding footing to go back to just a capitalist market. We're having a really tough time resetting. And in having a hard time resetting, we're all over the board. Again, we've had the Fed support the market for so long with so much good news, so much money, that we're at this point having to find. It's like being injured but never being allowed to exercise for yourself. I think our market has to have a couple face plants into the ground, a couple hard knocks to get itself back on its feet and start to understand the new normal, the new pricing, where we're at, where we're going to go based on today's facts and figures, which makes it obviously pretty difficult. The above the rest of the market's being broken. Thank you. I think the markets are broken because of what the Fed has done. So is it a Fed reality? I think it's a no Fed reality, right? With the Fed somewhat out, now the reality is earnings suck. Earnings suck for companies. With the Fed out, nothing to hang your hat on for support. With the Fed out, no Fed put in place. With the Fed out, stocks we aren't seeing people buy quite as many shares of their own stock back. Yeah, I mean, it's a no Fed reality, right? What other questions do you guys have? I'm going to kind of fill this in a little bit, but I would like to be able to answer any more of your questions as I'm filling this in for you guys. So, will you be totally protected from the FOMC in March? Rick, no. Rick, I would most likely not be totally protected for the FOMC meeting in March. I can't see why they would raise rates. That's going to depend when earnings come out for some of my companies, though. And in all honesty, April, May's are when I would be more worried about being literally collar trading and protecting for the Fed meeting, for the second quarter earnings, and for the summer, the sell in May and go away. That's where, excuse me, that's where I feel I would be wanting to make sure I was completely protected. So I would probably not make an individual collar or start to protect just for the Fed meeting in March. Now, I'm saying that now. We get a big rebound, and I hear some more of the Feds talk about continuing on their plan of action because they're a bunch of idiots and are completely disconnected from the real world, then yes, I may change my tune. And if I change my tune, it's because of new information that was basically sent my way. And that would be, I guess that would be my best guess for that time. PYPL. PayPal. In all honesty, I would not be in PayPal right now because it's a new company. So, PayPal, not enough data, not enough earnings reports. It's rather a new company. I would be protecting PayPal. I'd be starting to look at its earnings and set in for the year. So, in regards to PayPal, great opportunity to pick up shares. No comment. It's a relatively new company because it was broken off of eBay, in which case you have to treat it as an IPO and find direction, find commonality, give it time to create patterns of support and resistance. Can you comment on how oil is affecting the market? Dave, oil is making, for the most part, every manufacturing position in anywhere easier, cheaper. It's making transportation easier and cheaper. It is a net benefit to the economy. It is a net benefit to the consumer. So, Why is it causing so much havoc? It has fallen too far too fast with an oversupply. We have idiots for analysts that think that because they cannot understand the supply and demand and see how supply has gone up so much, that we have slower global growth because of the falling price in oil. Again, I think people are idiots, because oil should be a net positive all the way across the board, obviously, unless you're an energy company. What do you think about getting into oil stocks? Call it, of course, with the idea that they're near bottom. Dan, I don't believe, looking at the volume of oil that's come on the market and the volume of oil that keeps coming on the market, plus the reserves that are in place, I would not be trading oil stocks till probably 2017 or 18. And that's more towards the end of 2017. You're going to see companies get taken out, which still has not occurred. So I think people that are trying to call a bottom at 50 were idiots, at 40 were idiots, at 35 were idiots, at 25 were idiots. Unfortunately, so much new oil has been pumped in there that this is going to take a restart. And I never thought I would say this. It would not surprise me to see oil down at $20 to $18 a barrel. So I would not be trading oil stocks at this time nor anytime soon. I might look at some quick spread trades on jumps on oil. Bull calls are how I would attack it. I would not be doing bull puts. I'd be doing bull calls and taking my money and running in quick trades. And Rick said, I'm not sure how the crowd will react to the FOMC regardless of their decision. Rick, I'd agree with you. It's a crapshoot, but I'm trying to think that the FOMC can see that the Bernanke experiment got us out of a Great Depression, but it's also an experiment on how you're going to get out of the quantitative easing. And there's really no true game plan other than let it burn off. Rick, if no increase, people will think the market's worse than the Fed is telling us. Yeah, you know what, Rick? Great example. You know what? Sometimes I wonder why we always have to have a reason to justify something in the stock market. Because there are times that there is not a reason. But we're always trying to make up reasons for things that occur in the stock market. Plain and simple, we've been floating on the Fed dollar. The market's trying to learn how to recap itself. She all but told us she didn't do her rate hike in September when it should have been the ultimate time. She just said, I am too chicken to pull the trigger. Rick, you might be exactly right. You're damned if you do, you're damned if you don't. If they increase it, it crushes our stock market and our economy a little bit more, makes it harder to borrow money. If they do it, we fight all that. If they don't do it, we got to make up reasons why they don't do it. Down might be the direction we're going. Abraham, Parallel 27 gig contracts today. Nice quarter for recent equity. Yeah, I mean, it looks really good. The key is it's too young to see support and resistance level. Haven't had enough earnings to judge it against previous year comps. It's obviously the better part of what used to be eBay, right? Rick, if oil goes up, more wells will come back in the market, resulting in lower price again. It's a vicious cycle. Agreed 100%. Rick, I'm looking for banks with lots of loans into the fracking industry, then short them. That's a great idea. I'm looking more for the bigger banks to go long on housing mortgages where no fixed expense changes, but they make more money with a higher interest rate. And I'm actually in the FLX, I believe is what it is. All right, guys, I hope this was helpful for you. If you don't mind, let me go ahead and get this saved, get it out on my websites here for notes. In fact, maybe I should just, maybe what I'm going to do, I'm going to get these notes on one of my websites, the Hurley Investments or the My Hurley Investments blog site, and I'm just going to make sure you guys have a link to it for, I'll do a YouTube link right out of the gate so that you guys have an opportunity to just click on it and go to YouTube if you guys choose. Hopefully this was helpful for you. I appreciate those that showed up today. Again, if you didn't hear it, I'm going to get this off to Jeffrey, but also on my websites, the My Hurley Investment, My Hurley Investments, Hurley Investments or My Hurley Investment. I will get these up and so you guys can listen to the recording. Have a wonderful night. I appreciate you guys being here. Thank you very much, and I look forward to seeing you again next week, 5 p.m. Mountain Standard Time on Wednesday. You guys take care. Bye-bye.